In the world of business, growth is the goal. But cross a specific, invisible line in the tax code, and you shift immediately from operating independently to facing mandatory, intense regulatory scrutiny. That line is drawn by Section 63. It is the legal mechanism that forces a taxpayer to hire an independent accountant to audit their entire set of books. Section 63 operates with mathematical certainty. The audit requirement triggers automatically the moment a business hits specific financial volume limits. Once you cross that threshold, you completely lose the legal authority to self-verify your own financial records. Section 63 turns routine bookkeeping into a strict legal liability the moment a taxpayer's operational scale hits these specific numerical tripwires. To find where these tripwires are placed, we have to look at the primary divide in the tax code for this section. The law categorizes taxpayers strictly into either a business or a profession. This decision tree maps the rules. For a standard business, a mandatory audit triggers if gross receipts exceed 1 crore rupees annually. For a profession, like a doctor or lawyer, the tripwire is lower. An audit becomes mandatory once gross receipts pass 50 lakh rupees. These are strict top-line revenue limits. They're calculated annually, regardless of your actual profit margins, or even if the entity sustained a massive loss for the year. Standard analog operations are tightly bound by these 1 crore and 50 lakh ceilings, forcing a business to build out compliance infrastructure rapidly as top-line revenue grows. The government does offer a massive statutory exception to the standard business rule, designed explicitly to reward digital financial transparency. A dual condition applies. Aggregate cash receipts and cash payments must each stay below 5% of annual totals. Meeting this limit expands the audit tripwire from 1 crore to 10 crore rupees. Beware, bank drafts or non-account payee checks are legally classified as cash. Transitioning to purely digital liquidity provides a strategic buffer against the costs and administrative burden of premature regulatory audits. We also have to account for taxpayers who operate under specific presumptive taxation schemes, namely Sections 58.2 or 61.2. These sections utilize a deemed profit concept. The government legally assumes a fixed profit percentage based purely on the entity's turnover, streamlining the entire tax process. This balance scale illustrates the compliance trapdoor. If a taxpayer decides to claim that their actual profits and gains are lower than these legally deemed profits, an audit is instantly mandated. The inverse rule holds true as well. If the taxpayers simply declare their income exactly as per the presumptive scheme's percentages, the Section 63 audit requirement does not apply. Choosing to deviate from the government's presumed profitability matrix removes the benefit of the doubt, demanding absolute, auditor-verified proof. Beyond the financial thresholds, Section 63 enforces a rigid temporal countdown for compliance. This timeline outlines the exact mechanic. The specified date for completion is a hard deadline set precisely 1 month prior to the standard due date for furnishing the return of income under Section 263(1). By the specified date, the finalized report must be submitted in a legally prescribed form and duly signed and verified by the accountant. If a taxpayer is already required to get an audit under a completely different law, they simply have to furnish that alternative audit report alongside the prescribed accountant's report by the specified date. Surviving the Section 63 tripwire is a test of precision, requiring taxpayers to perfectly monitor their financial limits, control their cash ratios, and beat a rigid statutory countdown.